All right, so it's now 10 years later. We're going to go back and visit the Schmidts, and now we are in career phase 3, or I should say life phase 3. They're at the peak accumulation stage, and they're now 55 years old. So over the past decade, they've progressed in their careers, and they've seen rising incomes. And again, not surprisingly, because the case studies in the CFA literature, these people are the luckiest, most successful people in the world. I'd be shocked if I didn't see rising incomes and success. So, Jessica's employer is making significantly increased contributions to the firm's pension plan, and Jessica has also been aggressively contributing to this plan and her new private pension plan, partly because of the tax breaks. So they really followed some of our recommendations from the second stage. Now, the segment of the technology sector that Jessica competes in, they're now facing challenges in the market. Now, Paul's job remains steady, and he has consistently contributed to a private pension plan. The Schmidt's investment portfolio has grown substantially from regular contributions and investment returns, and the portfolio is now invested in diversified funds instead of the 10 IT stocks. And what do we see? Well, they're 70-30 portfolio. So 70% is in stock, primarily global equity, plus some Eurolandian stocks. And the fixed income is divided evenly between domestic government bonds and high quality bonds. So the asset allocation so far looks pretty good. Now, the value of the residential home has seen a decline in real terms due to the softness of the Eurolanders' real estate market and the local area losing its previous appeal. So I'm glad they didn't buy that investment property that they talked about. Now, the Schmidts have also paid down their mortgage, and they're still supporting Roxanne, their oldest daughter. Congratulations to her. She just completed her undergraduate degree. And of course, the parents never win. So now she's going to graduate school. Okay, so what else is going on? The couple continues to provide for the special needs of their son, Peter, who is now 17 years old. Now, Peter has been making progress, but unfortunately, they found he's going to need assistance for the rest of his life. They estimate about 13,000 euro per year. The Schmidts also plan to retire in 10 years, so they'll retire at age 65, and they maintain a healthy lifestyle. So together, they compile a summary of the current financial circumstances. So what do we see here? Annual gross income, $120,000 for Jessica. Net income, $77,800. She's still the department head of IT. Paul's still a teacher. So we're seeing now their combined annual gross income is about $200,000, with the net income at about $131,000. And we can see for annual living expenses, they're still around $75,000. Property is worth $340,000. Bank account, they kept at roughly $80,000 liquidity. Now their investment portfolio is substantially increased. It's $611,000. And you can see some pension provisions that they have. We see the private life insurance is still at $1 million for Jessica and $900 for Paul. And then we still see the disability policies as well. Now, what are the objectives that the couple want to achieve during this peak accumulation stage? Now, this is often when we'll see conflicting objectives. So as a private wealth manager, this is part of your job, is to help them figure out which one they're going to focus on. So what are their financial objectives? They want to maintain financial security over the next 10 years while continuing to work full-time. They want to have a comfortable retirement. They want to be able to provide Peter with lifelong support and assistance. And they also want to leave a substantial inheritance for Roxanne. So the question is going to be, can they do all of these things? Now, earnings risk, these still exist. So unemployment, profitability is volatile in Jessica's industry. If she loses her job at 55, they say it may be hard for her to find equivalent employer. I'm going to say it will be hard. Maybe impossible. Now, in disability, the couple maintains a healthy lifestyle, but the risk of losing future earnings due to disability, it still exists. Their current earnings situation, we're going to have to examine it to see how much would be covered by Social Security. So we look at the disability insurance coverage calculation in this peak accumulation stage. So Jessica needs $77,900 net income to be replaced. Paul needs $53,900. We can see there's a shortfall of Jessica of $47,180. For Paul, it's about $17,030. We're worried about 10 years. So present value, Jessica needs about $452,000 replacement, and Paul needs about $167,000. Now, once again, as we mentioned, there is a shortfall between the Schmidt's net income and what would be covered by the Social Security system. However, the couple does have more than enough supplemental insurance coverage to handle this shortfall. And with the adjustments they made to their coverage 10 years ago, Jessica and Paul have disability coverages of $633,900 for Jessica and $365,700 for Paul. Now, the premature death risk still exists too. So one of the couple's objectives is providing financial security over the next 10 years for the family. An early death could easily cause problems for this. So both Jessica and Paul have life insurance. We're going to have to look at their current coverage, see if there's any adjustments to be made. Okay, so we look at the life insurance coverage calculation. So actually, they both have too much insurance at this point. So recommend additional life insurance using the human life value for Jessica. She has $17,000 too much. Paul has $400,000 too much. And using the needs analysis, we're at $782,500 and $1 million for Paul. So regardless of whatever method we use, the couple's current life insurance is more than enough to cover the surviving spouse's financial needs. In retirement, the couple has continued to contribute to the mandatory government pension, and in their retirement in 10 years, they'll be age 65. The Schmidts expect to immediately purchase a fixed annuity. Okay, that's a great idea. That works with longevity risk. They can eliminate that part. And here's some more assumptions. So we look at Paul's mandatory government pension. It's a type of account. It's a defined benefit plan. Expected annual gross pension of about $48,950. What is the risk? Governments may reduce retirement benefits due to fiscal pressures. Certainly that's a possibility. Jessica has a defined benefits plan. What do we see here? She gets $28,190. Same thing, same risk above. And then we look at Jessica's company's pension, Paul's pension, and Jessica's private pension. And what do we see from the pensions? We see a total income of $111,531. Now, excluding the investment portfolio, the couple's estimated total pension that we just talked about, $111,500 before taxes, or roughly $84,000 after taxes. Now, they're going to need, they think, about $75,000 in after tax to live on retirement. Now, risks to these assumptions include loss of employment, any issues of solvency in the state pension system, and what if you get poor returns in that defined contribution plan right before the couple retires? So absolutely these risks exist. Now let's look at the investment portfolio. What does it need to do? It has two objectives. Support Peter and leave an inheritance for Roxanne. Now, when you're dealing with multiple goals, we want to focus on what's a probability of success, what's okay, what's not, what's a required probability. So the couple states the probability of success for supporting Peter, they want 100%, and they want the probability of success for leaving inheritance to Roxanne of 60%. So what does this tell me? This investment portfolio, we really should break it into two pieces, and we should use a goals-based approach to support Peter and Roxanne. Now, how are we going to support Peter? Well, even though he has some medical issues and some developmental issues, he's expected to survive his parents by 40 years to roughly age 90. So the couple estimate it costs $13,000 to care for Peter each year, and this is going to increase to $30,000 per year if they have to use outside help. Now, assuming that Schmitz assists their son up until retirement, the present value of these costs are going to be 500,000 euro. Now, this amount is actually less than their current portfolio of 611,000 euro. Now, what about the inheritance for Roxanne? Well, we have a lower probability of success. We have a longer time horizon. So, and when asked about a dollar amount, the couple said they want to leave as much as possible. Well, as a portfolio manager, how do I leave as much as possible? To me, that's not very helpful at all. Now, looking at the portfolio, we do know that Roxanne's portfolio, her ability to bear risk is much higher. So when we get to the asset allocation, we need to first address supporting Peter, and then the remaining balance is going to be inheritance for Roxanne. So we're going to have two portfolios. Okay, now let's look at earnings risk. We still have unemployment risk. It is almost impossible to insure against job loss. The couple has built up savings, effectively self-insuring against this loss of employment. Now, in regard to disability, the present value of the earnings not covered by Social Security, they estimate $452,000 for Jessica and $167,000 for Paul. So the couple has more than enough coverage through their disability insurance. So Jessica has $633,000 and Paul has $365,000. We're going to actually recommend to decrease this coverage. It's just too much. Now, what about premature death? Still exists, but as in the case of disability insurance, they have too much life insurance. So we're also going to recommend decreasing this coverage to lower those premiums paid too. Now, in retirement savings, the Schmitz are in a position to retire comfortably, so check. Their current projected income, assuming they continue to contribute that maximum amount from their pension assets, in excess of their projected spending needs. So they're good. So what should we tell the couple to do? Keep contributing the legal amount to your pension plans. Now, let's get into this portfolio asset allocation. Because the couple's first retirement goal was to live comfortably, we're good. We met that goal. So now we can focus on the other two objectives, supporting Peter and leaving an inheritance to Roxanne. Okay, so the current balance of their investment portfolio is a little over 600,000 euro. The couple has been contributing 33,000 to this portfolio on an annual basis. We're going to recommend, hey, keep doing this. And again, the higher the contributions, in addition to any capital gains and dividends, the higher the probability of meeting all of the couple's objectives. Okay, because the couple has multiple objectives that span multiple time periods, we want to incorporate a goals-based investing approach. This difference this differs compared to an institutional account. We're typically not going to use goals-based investing for an institution, but it's very likely, and you can expect it on the exam, it's a very reasonable way to manage a private wealth client's money. So we're going to use this approach. We're going to create 2 sub-portfolios, each of them to correspond to Peter, and then leaving inheritance to Roxanne. In Peter's portfolio, so currently we have 500,000 euro. It's 70-30 fixed income, and we're going to gradually move more of this into inflation-protected government bonds. This is going to help ensure the portfolio maintains real value over time because we're not going to touch this portfolio for almost 20 years. Okay, Roxanne's sub-portfolio. Well, most of this portfolio that they have is allocated to Peter's long-term care. She only has 111,000 roughly in investable assets for Roxanne's account, but her ability to bear risk is higher than Peter. So she has an even longer time horizon, 30 plus years. So they're going to recommend to put 100% into diversified global equity funds to benefit from these high expected returns from equity. Now again, bear in mind, it is important to review these allocations, and we need to make sure that they stay in line with the goals that have been established, and we need the Schmidts to continue to save and accumulate assets. So what does this mean? We're going to have to monitor the portfolio regularly. So at a minimum, we're going to review the IPS annually, and we're going to make any significant changes to the IPS as soon as any type of material change occurs. So again, we've covered now the 3rd stage, the peak accumulation stage. We only have one more stage where the clients go into retirement. But again, what I want you to think about as you prepare for this exam, I've only been helping you paint this long, realistic case. We haven't been talking about how to calculate questions, how to analyze this. Remember, this is what you're going to be tested on. They're going to give you parts of these cases that you're going to have to do something with. So again, if you just watch these lectures, your studying is incomplete. You need to go back to the Kaplan material, use the quizzes for each of these sections, and make sure you're gleaning the information you need to get out of this to score well on the exam, and go back to the CFA source material here as well. I truly believe you cannot work too many private wealth or institutional problems. So let's go ahead and jump into the last stage.